Warren Buffett once made $1 million bet that a simple index fund would outperform the best hedge funds on Wall Street over 10 years. No tricks, no complexity, just low fees and patience. He won, big time. The lesson? Wealth isn't built through complexity, it's built through consistency. Today, I'll break down the 4 most popular investment types: index funds, ETFs, mutual funds, and hedge funds, and show you which one could grow your money the fastest, with the least stress. Here's exactly what we're covering today. First, I'll explain what a fund is using a simple analogy that makes everything crystal clear. Then, I'll break down all 4 types of funds, showing you the pros, cons, and who they're really designed for. We'll dive into the real costs, hidden fees, and performance differences that could make or break your financial future. Finally, I'll share 2 bonus strategies that most investors never learn, including one technique that could save you tens of thousands in fees. Before we dive in, let me share an analogy that'll make everything click. Imagine you and 9 friends want to throw the ultimate pool party. You could each try to buy everything individually, but that's expensive and risky. Instead, you all throw your money into one big pot. Now you can afford a bigger pool, better food, a professional DJ, and amazing decorations. That's exactly how investment funds work. Instead of trying to pick individual stocks, you pool your money with thousands of other investors. The fund uses that massive buying power to invest in hundreds or thousands of companies. If one company fails, it barely affects you. If the overall market does well, you get your share of the profits. But here's where it gets interesting. There are 4 different ways to organize that pool party, and each one has dramatically different costs, risks, and potential returns. Index funds. Let's start with index funds, the boring investment that's made more millionaires than any flashy stock pick. Index funds are like having a robot manage your money, and that's a good thing. Instead of trying to pick winning stocks, index funds simply copy a list of companies called an index. The most famous index is the S&P 500, which tracks the 500 biggest companies in America. Think Apple, Microsoft, Amazon, Google. Basically the companies that run our economy. When you buy an S&P 500 index fund, you're buying tiny pieces of all 500 companies automatically. The beautiful part? You don't need to research companies, time the market, or make any complex decisions. The index fund just follows the index, buying more of the companies that grow and reducing positions in companies that shrink. This passive approach keeps costs incredibly low. Most index funds charge between 0.02% and 0.20% annually. That means if you invest $10,000, you might pay just $2 to $20 per year in fees. Compare that to some actively managed funds that charge $150 per year on the same investment. Here's the catch. You can't buy and sell index funds throughout the day like stocks. They're priced once daily after markets close, so if you place an order at noon, it won't execute until evening. For long-term investors, this doesn't matter. Mutual funds. Now let's talk about mutual funds, which look similar to index funds but work completely differently under the hood. While index funds use a robot-like approach, mutual funds employ human fund managers who actively try to beat the market. These managers spend their days researching companies, analyzing trends, and making buy and sell decisions. The idea sounds appealing. Professional experts picking the best investments for you. But here's the reality check. Most actively managed mutual funds don't beat the market consistently. Studies show that over 15 years, roughly 90% of actively managed funds fail to beat a simple S&P 500 index fund. Plus, all that active management comes with a price. Mutual funds typically charge 0.5% to 1.5% annually, sometimes more. Over 30 years, the difference between a 0.05% fee and a 1.5% fee can cost you over $100,000 on a $100,000 investment. However, Some investors prefer mutual funds because they want exposure to specific strategies or sectors that aren't available through simple index funds. Companies like Vanguard, Fidelity, and JP Morgan offer both types, so it's important to check which you're buying. Hedge funds. Moving into hedge fund territory, we're entering a completely different world, one that most of us will never access, and that's probably a good thing. Hedge funds are like the VIP section of investing, but with casino-level risks. These funds use tactics like short selling, massive leverage, complex derivatives, and investments in everything from currencies to commodities. They're managed by financial wizards who have enormous freedom to make bold, high-risk moves. Remember, these aren't available to regular investors. You typically need to be an accredited investor with over $1 million in assets or $200,000 plus annual income. The fees are legendary for being expensive. The famous 2 and 20 structure means you pay 2% annually just for management, plus 20% of any profits. So, if your hedge fund makes 10% returns, you pay 4% in fees, leaving you with just 6%. Compare that to an index fund, where you'd pay 0.05% and keep 9.95% of that same return. For the average investor, hedge funds are more like expensive entertainment than practical wealth building. ETFs. Finally, let's explore ETFs, exchange-traded funds, which combine the best features of index funds with the flexibility of individual stocks. ETFs are like index funds that have learned how to trade in real time. Just like index funds, most ETFs track an index and provide instant diversification across hundreds or thousands of companies. But unlike index funds, you can buy and sell ETFs throughout the trading day, just like individual stocks. This means you can see real-time prices and execute trades immediately. ETFs also maintain the low-cost advantage of index funds, with expense ratios typically ranging from 0.03% to 0.75%. Many brokerages offer commission-free ETF trading, making them incredibly accessible. Want to invest in the S&P 500? You can buy it as an index fund or as an ETF. Both track the same index, but the ETF gives you more flexibility. There are ETFs for everything: US stocks, international markets, specific sectors, bonds, commodities, and even cryptocurrency. The verdict. So, which type of fund should you choose? The answer depends on your situation, but here's my breakdown. For beginners and long-term investors, index funds and ETFs are usually the best choice. They're low cost, simple to understand, and provide excellent diversification. The main difference is that ETFs trade like stocks, while index funds are priced once daily. Mutual funds can make sense if you believe in a specific manager's strategy or want exposure to specialized sectors not available through index funds. Just be aware of the higher fees and the fact that most don't beat the market consistently. Hedge funds are designed for wealthy individuals who can afford to lose significant money in pursuit of potentially higher returns. They're not suitable for average investors building retirement wealth. The key insight? For most people, simple and low-cost beats complex and expensive over the long term. If you've made it this far, you're serious about building wealth. Here are 2 advanced tips most investors miss. 1. The hidden cost of fees. A 1% annual fee might not sound like much, but over 30 years, it can reduce your portfolio by up to 25%. You're not just losing the fee, you're losing all the compounding that money could have generated. Always factor fees into your total return. 2. The power of rebalancing. Automatic rebalancing keeps your portfolio aligned by selling high and buying low. It can boost long-term returns by 0.5% to 1% annually. Most brokers offer it for free. Take advantage of it. You now understand the 4 main types of investment funds and when to use each. The biggest mistake isn't choosing the wrong one, it's never getting started. Whether it's index funds, ETFs, or mutual funds, what matters most is starting today. Your future wealth depends on action, not waiting for the perfect strategy. If this helped simplify things, hit like, share your favorite fund in the comments, and subscribe and turn on the notification bell for more no-fluff wealth-building advice. Remember, simplify money. Muchafy wealth. One smart decision at a time.